Welcome to Retiring Well. We're so happy you joined us this week. We have some great topics lined up. We're going to start the show off by talking about why the yield curve matters. What does that mean to you and potentially your retirement portfolio? We're going to be talking about the income bucket approach and the income ladder approach, how these things differ, and how as you build retirement income, one may be appropriate for you. And at the end of the show, we're going to bring back a little blast from the past on a story about how two similar portfolios can lead to vastly different results. Stay tuned because we're going to be diving into all of this and much more this week on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
All right, let's talk about why the yield curve matters. There's a whole lot for investors to be paying attention to, especially inflation right now that's at a 40-year high, but ultimately this yield curve. So normally when you're looking at a yield curve, the shorter term yield is going to be a reduced amount versus the longer term yield should be a higher percentage. So the concern out there right now is when you see the 2-year yield increase above where the 10-year yield is, which we saw not too long ago, that creates what's called an inverted yield curve. So why does this really matter? Well, it creates a lot of uncertainty with the economy. You figure if you can get a higher percentage rate on a short-term versus a long-term investment, that has a lot of investors concerned. So another key piece of this is that inverted yield curve can be a indicator of a potential for a recession. Now, it doesn't always mean that the recession is going to come, and perhaps it's maybe not for some period of time before you experience that recession. Maybe it's a year and a half or so before you start to see that. Again, there's no guarantees on what's going to happen there. So why is it that yield curves matter? It's as referenced earlier, the 2-year got to a higher percentage than the 10-year rates. And so some analysts may look at that as sort of their primary indicator. Others may prefer to look at maybe a 3-month yield versus a 10-year yield and what percentage rates those are paying, which hasn't gotten to that inverted point yet. You know, I think back, we looked to 2019 and there was an inverted yield curve, and shortly thereafter a recession occurred in 2020, but that we believe had a whole lot more to do with the pandemic versus what the economy was doing. And so ultimately you experience the economy sort of shutting down for a period of time. That had a whole lot more to do with why there was a recession at that time. So there's always going to be more to the story, whether that's looking at yield curves or inflation, the overall general economy, what the markets are doing, not just the equity markets, but looking at the bond environment and ultimately what we're seeing going on with interest rates and what impact that can have on your portfolio. So that's something where for our clients at Centennial Wealth Advisory, we do a quarterly market update where we host those and try and educate everyone on here's all these different factors that you should be paying attention to during and throughout your retirement years. So again, if there's certain areas that you have questions about, feel free to give us a call.
What a great segment there, and very timely with everything that's going on in the world right now. You know, in the Gaylord office, it's pretty typical that we see a couple nowadays come into the office. They've either had been working in the Detroit area for a number of years, they've got this 401k, and with everything going on in the world, they want to know what they need to do to retire well and be conservative with the funds that they've worked their entire life for. And given there's so much negative news out there, the yield curve inverting, worst quarter in bonds in the last 30 years, there's a lot to be fearful from. But it's important to remember, you got to have somebody looking out for your best interest. And here at Centennial Wealth, we're independent advisors. So when you bring that 401k to us from your job that you've worked so long to save for, and you want to look at those different options, we have unlimited options to offer you to help offset those fears that you're feeling in the market right now.
Absolutely. I think I appreciate that Nick brings up just the fearful times that we have right now. And when I'm in the Cadillac office, and I will have a similar scenario where somebody might have moved up from to an up north cabin, and they're saying, hey, we're so excited to start our retirement. Okay, now what? And then they bring in these questions, great questions about, hey, we just heard a big old headline from the yield curve inverting. What does that mean? To be able to sit down and teach is something that I love to be able to do. We get to explain what that means. We also get to give some historical data on what has happened after the yield curve inverted. What are the things that we want to look for? But most importantly, what is your plan? You know, we get to lead by learning, and we get to say, all right, well, let's learn about you. Let's learn about what options make sense to you, and then let's explain without any kind of obligation or any kind of requirement to do business. Let's just show you what options are out there. I think the best way to attack problems is with a proactive plan. And so as we go through these really, really tough, volatile, scary times, we want to have a plan. So, of course, feel free to call, to reach out to our website. You can get a hold of us a couple different ways. Stay tuned. Coming up next, we have the income bucket approach and the income ladder approach. Stay tuned.
Are you retired or approaching retirement in the next 5 to 10 years? Join the Centennial Wealth Advisory team for an exciting presentation with complimentary gourmet dinner and learn essential financial strategies for a comfortable retirement. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Call 888-608-5825.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review. All right, so you've now worked for maybe 20, 30, 40 years or more saving for your retirement. That day is nearing, and what do? So you've accumulated this nest egg. You have these maybe savings accounts, IRAs, Roth IRAs, 401ks, whatever it may be. But now what? It has to generate a paycheck to you, right? That's, the point you've been saving for. So hopefully, maybe your Social Security, you'll receive that at some point, depending upon what that is. Maybe you're one of the fortunate ones to have a pension. But for most, that nest egg that they've saved for is going to be a primary income source. So how do we establish income or a paycheck from that? Something I heard years ago that I thought was quite right. Retirement is like 20 to 30 years of unemployment. So how are you going to get paid during that time? Well, one approach is what we call the income bucket approach. And it's basically carving out a portion of what you've saved for your retirement. Now, that portion is going to be different for every person because everybody's needs are likely different in retirement. Obviously, if you have maybe a smaller Social Security and no pension, potentially that need is going to be greater because you're going to need to make up that income gap difference from whatever your budget may be. Maybe you're fortunate to have Social Security and pension, and that need isn't quite as big because you have some of those bases covered. But whatever it is, the theory is there's a peace of mind knowing that with this big chunk of retirement maybe that you've saved, that a portion of that is going to take care of your income needs. Now there's very specific investments and strategies and stuff that implement, and we'll get into that at a later time, but mainly I want to think about that concept. What if you had that, I look at your statement, right, and you have this dollar amount specific to your accounts. What if you were able to take that and know that a portion of that was going to cover your income for the rest of your life? And then the rest of it was there for the extras, the helping of the kids, the remodel of the house, or the trips, but you know that your income is taken care of. A lot of people find peace of mind in that because there's some uncertainties with retirement, right? How long am I going to live? Maybe what is inflation going to be like? What are these other aspects that I have to worry about throughout these next 20 to 30 years of my life potentially? And how am I going to make sure my money outlives me? So, when you're thinking of how to build an income plan, this is one approach. Here at Centennial Wealth, we love to sit down with you and help you walk through all those aspects of what that could potentially look like for you, and if the income approach is the best for you of slicing out that bucket so you feel confident in knowing that income is going to be there for you.
Every success story starts with a plan. The success of your retirement depends on a solid financial plan. If you are nearing retirement or already retired, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning, serving all of northern Michigan, with offices in Traverse City, Cadillac, Petoskey, and Gaylord. Our presentation includes: is your retirement prepared for inflation? Do you know the true risk of your investments? What happens to your assets when you pass away? Do you have a tax plan? How does your income affect health insurance costs? And much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, June 14th, at Lakeside Charlie's in Cadillac, or Thursday, June 16th at the Otsego Resort in Gaylord. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and tends to fill quickly. Call 888-608-5825 to reserve your seats today. Don't miss this important live event to help you plan to retire well. Call 888-608-5825 today.
When it comes to your financial future, what's the value of a truly objective opinion? As someone looking for financial guidance, you have choices. There are thousands of captive financial professionals who work as employees for large national insurance companies and brokerages. There are also many independent financial professionals who aren't bound to any given insurance company, investment strategy, or product. So what's the difference, and why does it really matter to you? Consider this. If you walked into a doctor's office with a sore throat, a bad cough, and a high fever, you'd expect that doctor to assess your symptoms, do a thorough diagnosis, and ultimately hand you a prescription written to cure your particular ailment. In other words, you'd expect the doctor to consider all the medications available and give you his or her absolute best thinking on what's best for you. On the other hand, if that doctor opened the cupboard and only had 3 or 4 prescriptions available, maybe those offered by his or her favorite pharmaceutical rep, most patients would immediately raise an eyebrow, suspicious that they might not be getting what was really in their best interest. The same may be true for your financial well-being. If your financial professional is an employee who's contractually bound to represent a given insurance or investment company, only offering their products while there are literally hundreds of others available, how sure can you be that you're being offered what's truly best for your situation? You don't walk into a tailor or seamstress shop to get clothing off some rack. You go for a custom tailored fit. And with something as important as your financial future at hand, the stakes are even higher. We believe you deserve a truly objective opinion. We think you deserve to consider more of the available options. And we believe your financial future is worth a custom-tailored prescription to help you feel confident for the days ahead. If you'd like a second opinion on your current retirement strategy, simply contact our office today.
All right, let's share with you this income laddered approach. And this little story doesn't necessarily have specific things to do with what we're talking about, but I remember going with my dad here in Traverse City to a local bank when I was a teenager, and so we were in the late 90s, and Dad said, well, let's go to the bank. They've got a CD, this certificate of deposit, where you can make interest, and at that time it was about 6% interest on this CD, and I thought, well, that's great. I can make some interest and make money not having to work for it. And so I think with that, a lot of you may have heard of CD ladders, where maybe you have differing maturity dates, a 1 year, a 2 year, a 3 year CD, where hopefully you're getting a little better interest the longer that you're in that account. So similar concept here, where we talk about this income laddered approach. So you may have a multitude of different investment types of accounts, insurance types of accounts, bank accounts, whatever it may be, and you're creating then this overall long-term plan. So let's imagine for now that your goal is to draw a 5% of your money over a period of time. So worst case scenario, if you assume a 0% interest rate, that money should last you 20 years. Well, hopefully over 20 years you're making some interest on that. And so initially, let's say, okay, segment one of this is going to be providing you an income for maybe years 1 through 5. So you've set this money aside. Maybe it's going to be a low risk type of investment where now you're drawing that income from years 1 through 5. Meanwhile, the second segment, you've sort of earmarked that for years 6 through 10 to be generating an income stream from that. So maybe you're still not taking a whole lot of risk because that's the years 6 through 10. And then lastly, you've got years 10 and beyond. So you've got 10-year period to try and grow that money, and then when all's said and done, you can hopefully have made enough interest to then start that process over again. So there's the rule of 72, where you take 72, divide that by the rate of return to determine how many years it will take to double your money. So in this case, if we're looking at a 10-year time frame, ultimately 72 divided by 7.2% would be the 10-year time frame. So again, assuming all goes as planned, then you could structure it to grow that last segment to then replace that income that you've drawn out in the first two pieces. So again, this isn't necessarily going to be the only solution for your potential income planning and retirement, but it's definitely one that could be helpful. And if you need help mapping out a long-term income plan, then please don't hesitate to give us a call and let us help you plan to retire well.
Hey, welcome back. I hope that you got to find those two segments helpful in your understanding of what are ways to solve for the income plan in the first few years of retirement. One of the things that we have in all of our offices are whiteboards. And what I learned when I was teaching is that you could tell pretty quickly when people understood things and when they didn't understand things. And what I think you just saw in those two different segments are two different ways to really say the same thing. What's our income plan as we enter retirement for those first few years? See, one of the things that you have to be really careful of in your income planning as soon as you start in retirement are what is called sequence of return risk. What is the market going to do when you retire in your first few years? Nobody knows. So what we get to teach about are different plans that you can put in place to remove yourself from some of the market fears and some of the market dependency. having an income plan, whether you use the bucket approach or the ladder approach, really comes down to you understanding what your plan is. And that's why I love that we have this show to teach you. I love that you get to tune in each and every week to have that learning heart and keep understanding, all the different things that you have to look at when it comes to retiring well.
Yeah, I mean, the big thing I think Jack there is saying is you got to understand your plan, and those bucket approach or the ladder approach really helps you visualize the plan in place. Recent scenario out of the Petoskey office, we had a couple come in and they retired a little young at age 57, and we used the rule of 55, right? So he had some money in his 401k, we left some money back in the 401k to use for income, and then we rolled the rest the IRA. To help him visualize where he was getting money from and when, the whiteboard with a bucket approach worked perfectly for that scenario. We also plugged in the numbers to our retirement analyzer program so he could see, okay, 5 years down the road, 10 years down the road, this is where income is coming from and what bucket. So just one example there of utilizing that bucket approach to help visualize where money is coming from and when. All right, coming up next, we're going to be talking about two similar portfolios with two drastically different results. Stay tuned.
If you're retired or approaching retirement in the next 5 to 10 years, join us for an informative live event. This event is all about you, the challenges you face, and the information you need to help you build the future that you want. There's no pressure to become a client. Our goal is to simply give you valuable information that you can use to make smarter financial decisions. We hope that by the time you leave this event, you'll be one step closer to your retirement goals.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
All right, for some of you that have watched the show for many years, this is probably going to be a little bit of a blast from the past for you. We've talked about this before, but we thought it would be a great time to revisit it with some of the stuff that's happening out there in today's environment. So, let me set the stage here. We're going to have two brothers. They both have the exact same amount of money, $500,000, at the beginning of their retirement. They're actually going to even retire at the same age. They have the same mix of tax accounts. So the same mix of pre-tax, Roth, after-tax, that sort of stuff. They're both also going to be taking a 5% annual withdrawal rate out of their portfolio. So $25,000 a year they're pulling out from income from that portfolio, okay? And they're invested exactly the same way, in the exact same investment, okay? So after 10 years, the first brother has about $1.3 million. Pretty good, right? 10 years in the retirement, started with $500,000, has taken, over that 10-year period, they've taken $250,000 out. Remember, $25,000 a year, right? 10 years. They got $1.3 million, done quite well. The other brother has a little over $200,000 is all left. Same thing, took his $250,000 out, but only has that. What was different? I can tell you the only thing that is different, if you didn't catch it, is when they retired. So, one brother, the first brother did quite well, 1990 is when they retired. They experienced a great market run, okay? In that first 10 years, didn't they, in the early 90s. Second brother retired in 2000. Pretty bumpy 10-year period, right? Remember 9/11, that kind of dot-com bubble at the same time that was happening there, and then the 2008 financial crisis. So different 10-year periods. We bring this up because oftentimes we hear folks talk about, well, my friend has this investment, or my brother had this investment, or boy, I remember when this investment did really well, or even this investment has been great for me these last few years. I don't want to do anything different. Times change, and specifically if you're getting ready to head into retirement, this is a critical time to make sure you're positioned appropriately so you can have the best possible chance of success, and so that you don't outlive your money. So obviously most people have asked they'd prefer to be like the first brother that grew their portfolio while still taking income. That's not always possible for some people depending upon various circumstances. But remember, times change if you take anything away from this, and stuff that potentially worked some times ago isn't guaranteed to always keep working. So make sure you're having a second opinion on that portfolio, specifically for you if you're getting ready to retire.
Hey, welcome back. I hope that you got to find that valuable in understanding what markets can do to similar portfolios. One brother did fine. The market and the portfolio that he had structured worked out great for him. The other brother, same portfolio, different market, worked out very differently. I work mainly out of the Cadillac office, and I will have clients that will come in and they'll have old 401ks, maybe from jobs that they've left, or I see a lot where they're preparing to retire. And so whether they're from downstate or something that's just local, they usually have a lot of worry right now when they come in. Our slogan on our TV show is plan to retire well. It does not say plan to retire worried. And so because of that, I get to go through and do a lot of teaching. I get to say, all right, what are you worried most about? As they explain their fears, we get to talk about those fears and what's out there to address them. One of the fears that they have is, hey, did I save enough? And can I retire? Well, it depends on how much money you want to put into the market and rely on the different markets that you might see that you've seen in that scenario from brother one or brother two. So what we get to do is we get to construct a proactive plan to help you understand what your options are and how you might remove your retirement or a portion of it from the risk of sequence of return risk that markets produce.
Yeah, I think one of the biggest worries that I run into right now out of the Gaylord office is the fear of another 2001 or a 2008 come along and your portfolio loses half their value if it's all in the market. And so clients are coming in saying, hey, what can we do to minimize this market risk? And a lot of times the annuities word gets thrown out there, right? And I know sometimes it has a bad rap, but here at Centennial Wealth, like we've said before, we're independent. So if you're worried about that market risk and you want to look into annuities, we shop around and we find the best annuity products that are out there. There's not one silver bullet, there's not one best product, it's all based on what your needs are. And that's just one way to minimize market risk. There's lots of other ones out there. So please don't hesitate to give us a call on the number on the screen. We'd be happy to schedule that free initial no obligation consultation. And also don't forget to check us out on YouTube. You can just go to YouTube/Retiring Well and then check out a bunch of great information on there. And don't forget, you can also like or share and subscribe to our channel. All right, we'll see you next week.